Hello, everyone, and good evening. Welcome, and thank you for joining us to Market Update with Bob Westrick and Stephanie Link. I'm Nicole Young, the Marketing Coordinator for Private Vista and your host for today. Before we get started, I just have a couple of housekeeping items to ensure that you have a wonderful webinar experience. You'll notice that you're muted currently, and you'll be muted for the duration of the webinar. That's just to ensure that you can hear our panelists and that there's no audio interference. You'll also notice that the chat function of the webinar is turned off. This is a compliance regulation for our industry that we have to adhere to. So if you have any questions, feel free to submit them to me during the presentation by emailing me at info@myprivatevista.com. There's also another way that you can ask us some questions, and that's going to be during the Q&A portion of the event at the end of the event. Since we're not able to utilize the chat function, the way that you're going to do this is if you hover over your screen, you'll see that there's a raise hand function. Just click on that raise hand function whenever you have a question. That way we know during the Q&A that you have a question. I'll be able to call on you, personally unmute you, and you can ask your question directly to Bob and Stephanie. I'll give you guys another little reminder about that once we get to the Q&A. But just so you know, feel free to email me at info@myprivatevista.com or just utilize that raise hand function. Okay, that's it for housekeeping, but now I need to introduce these two other Zoom frames on the screen, Bob Westrick and Stephanie Link. First up, I'd like to introduce Bob. So in 1983, Bob left a Big 8 public accounting firm to work for one of his audit clients. 8 years later, his entrepreneurial itch was scratched and he started a partnership in the financial services industry. 2 years later after that, he co-founded WNA Wealth Advisors, one of the precursor firms to Private Vista. Currently, Bob chairs both investment teams at Private Vista. Bob earned a Bachelor's of Business Administration from the University of Notre Dame, as well as a Master's of Business Administration from the University of Chicago. He's a board member at the Ministry Formation Program, the finance chair at the YMCA's Men's Club, a member of the Salt Creek Club, and he somehow has time to also be a retired board member at the Plymouth Place Senior Living. Thank you so much for joining us, Bob. Next, I'd like to introduce you to the other box on the screen, and that would be Stephanie Link. Stephanie is a Chief Investment Strategist and Portfolio Manager at Hightower Advisors, LLC. Prior to joining Hightower, Stephanie was the Senior Managing Director and Head of Global Equities Research at Nuveen. Before joining Nuveen, Stephanie spent 7 years at the Street as Chief Investment Officer and Co-Portfolio Manager of Jim Cramer's Charitable Trust. Before that, she served for 10 years at Prudential Equity Group as Managing Director of Institutional Sales and Director of Research. Stephanie earned a BS in Finance at Boston College. She currently serves as a chairperson for the Investment Advisory Council at the Basking Ridge Presbyterian Church in Basking Ridge, New Jersey. And she's a board member at the Fingry School. Pleasure to have you joining us today, Stephanie.
Thank you, Nicole.
Absolutely. So now you've all heard enough from me, I think, and I'd love to turn things over to Bob Westrick to begin today's discussion.
Thank you, Nicole, and thank you, everybody, for spending part of your afternoon with Private Vista. Stephanie, thanks for joining us. We really appreciate it. It's both an honor and a pleasure to have you, to see you again. Let's start out the discussion by just a recap. It's December. It's been quite a couple of years. You know, if we just look at the markets, the S&P 500, 2019, we're up over 30, last year up over 18, and this year so far, we're up over 26%. What's contributed to such a strong year and years for stocks, especially during these COVID times?
Well, thanks for having me, Bob. It's a pleasure to see you as well, and to all of your audience. I think that these have been a very unusual times, and we're kind of spoiled with the returns that we've seen in the markets over the last several years. It's unusual because we now have, or we have had over the last several years, an unprecedented amount of liquidity that has been entered into the system, both from the Federal Reserve in terms of monetary policy, and then also from our government from the fiscal side. At one point in time, we had 60% of US GDP if you add monetary policy and fiscal policies together. That is an enormous amount of liquidity. Comparing that to 2008, the last financial crisis, if you added up what the government did in terms of policies put in place, what the Fed did to put policies in place, it was 8% of US GDP. So we basically threw everything at the economy because we had a crisis, because we actually closed things down completely. And we really never experienced something like that. And so I think it's really this liquidity event that has been driving money into the markets. And it's also the fact that we have also very low interest rates at the same time. And that is actually quite a positive, if you think about it, for the consumer and for corporate America. So you fast forward, and we have seen a V-shaped recovery since in the last year and a half. And that is mainly because we have been funneling money into the system and supporting anywhere we can. The Fed has been buying an enormous amount of bonds and what they call quantitative easing to try to support the markets. And it worked. We actually have seen recovery in the consumer. We've seen a recovery in manufacturing. We have seen a recovery in consumer and business confidence, and that's very important. It took a bit of time, but it did work. The plans put in place have worked. So to put this into perspective, if you go just back and look at some of the data that we have recently seen, I just want to show you the kind of the bounce back that we've had. The last quarter, we had an unemployment rate of 4.2%, pre-pandemic levels, right? We had job openings. They are aplenty. There are 11 million jobs that are open around the country. And we have people that are quitting their jobs without even having a job because they feel so confident they can get a job, right? So you have what we call quit rates, right? So you have job openings that are over 11 million. And let me just put that into perspective for you. Historical average is about 6 million, 6 million, right? So you're at 11 million. The quit rates are at all-time highs. That tells you the confidence is there. And then, oh, by the way, when you get a job, wages are up substantially. Wages are up 4.9% on an annualized basis. If you look at the unit labor costs, another funny way of saying wages, it was 9.6% in the third quarter. These are very, very high numbers. We're lucky if we get 2% in wage growth. That's about the historical average. So you can see that people can find the jobs. It's these companies that can't find people. And when they find the people, they actually have to raise their wages. So that's really great, by the way, for the consumer. So the consumer then took all that money, plus the stimulus checks that they had, and they put much of it into savings. And today, even though savings rate has come down, the savings rate is now at about 7.5%. And historically, that number is about 5%. So that's $2 trillion in excess savings that consumers have if we just get back to the average. So they've been saving, but they've also been spending. We had an interesting stat. They call it the ISM services. It's just a measure of the services side of the economy. This report came out last week, and it was at record highs. Why do we care about the ISM services? It's because services is 69% of GDP, of the economy. So we're rooting for the consumer, we're rooting for services, because up until now, it's been very much driven, the demand improvement has been very much driven by goods demand. And so I think you're seeing this transition into services, which is quite exciting. And there is this one component, I don't want to get too wonky, there's this one component within the ISM services report that I look at. It's very, very important. It's called new orders. And the new orders number that came in at an all-time high. Why is that important? Because new orders are a leading indicator for corporate earnings and CapEx, right? Companies starting to invest in their businesses. So the fact that the new orders is at all-time highs is really very, very telling and very encouraging. I look at the manufacturing side of the economy. It's a much smaller piece of the economy. It's only about 12% of US GDP, but there's a multiplier effect. For every one job created in manufacturing, 7.7 jobs are created around it. And so that is one of the reasons why you have seen all of this money from the government, the fiscal side of things, really focused on this infrastructure package, right? Because if you really want to get that unemployment rate down, and we've done a great job from where we were, but if you want to get that down further, manufacturing will solve a lot of problems fairly quickly. So you have a good jobs market, you have plenty of jobs out there to be had, you have higher wages, so people and consumers feel better, and you have the consumer really having actually a very elevated consumer confidence overall. It stayed fairly high. I know it's come down most recently, but it has stayed elevated. You have manufacturing data that is very strong in terms of ISM manufacturing that is well over 50. 50 is, it's a diffusion index. So anything over 50 is expansion. Anything under 50 is contraction. We have been in the 60s for 18 consecutive months. So manufacturing is doing well. And oh, by the way, inventories are at 5-year lows in manufacturing, right? And the supply chain issues, and we can talk about that if you like at some point, the supply chain issues are only feeding on that issue at this very moment. So where we stand is in the third quarter, we grew GDP at 2%. And that's because, Bob, you probably knew this and experienced this too. We had a pretty big slowdown over the summer months because we had the Delta variant concerns. And so things kind of came to a halt. You had supply chain issues. So we only grew 2%. And that's versus 6.8% in the second quarter. So we really decelerated. Well, there are forecasts out there at this current time for something like 9.7% GDP growth for the fourth quarter. So we have seen, again, that snapback, that V shape continuing in the economy. So good to see. Is it sustainable? No, it's not sustainable. And I don't even know if it'll really be 9.7%. I think it's going to be something more like 6-7%. That is still well above the average of 1.5 to 2%.
And a lot of that, I think, would be inventory, build up and growth. But unfortunately, with supply chain issues, that's probably not going to be. It's not going to all be pulled into this year. A lot of it's going to be pulled into 2022.
I don't think you're going to see the supply chains get fixed until second half of 2022. But I do think companies have done a really good job, as best that they can, in trying to get the products they need. And that's why I say that the services piece of the economy, the pent-up demand from the consumer, everybody wanting to go out and travel, leisure, and that sort of thing, that's really important to see that start to take over versus the manufacturing side. But the point I was just trying to make was we have above trend growth in GDP. We have above trend growth in inflation. And I do not believe all of it is, and I'd love your take on it, Bob.
And we'll talk about inflation as a separate topic.
Okay, because there's a lot to talk about. There's a lot to unpack. But I will say this, look, we do have above trend growth. We have above trend inflation. And as a result, the Fed, we're starting to hear them taper from this massive liquidity event, right? And they're going to probably increase the taper amount without getting too in the weeds. The point of it is the Fed can start to ease off of these emergency policies. We should embrace it. We should not be afraid of it. There are very many days, and I'm on TV for a living. There are very many days I say, just turn the TV off, because we want a little bit more growth and we want a little bit of inflation. And I don't think we're going to see runaway inflation, but we don't need these policies that were put in place when we closed the economy down.
You mentioned wage growth. Wage growth has been very uneven throughout the economy. Leisure and hospitality wage growth is like 16%, but there's other areas of the economy where there's not really been a whole lot of wage growth. It's really just been on lower paid workers, hasn't it?
It has, and in fact, to your point, McDonald's has raised wages 3 times this year. Bank of America just raised wages this year. And this is to the lower end, maybe the tellers kind of thing, and that sort of thing. But it has been more on the low end. But overall, it's going higher. The average is still quite a bit higher. And if that's if you look at a lot of different things, like I said, like the unit labor costs, you look at wage numbers from the non-farm payrolls, you look at the employment cost index across the spectrum, numbers are higher. And that is, again, that's a great thing for the consumer. It's just a very hard thing for companies to have to adjust to that.
Thank you. Let's talk about for a second now, this trends well, what you've been talking about, into inflation.
Yeah.
Through October, year over year, 6.2%. My question for you is, what do you think is driving it? Because inflation isn't everywhere. It's mainly energy, shelter, food, new and used cars, a few other areas. When you go take out the strip out food and energy, it's probably more around 4.5% or so of the core inflation. So what do you think is driving inflation right now? And what do you think the inflationary outlook for 2022 is?
Sure. So I think that you're spot on in terms of where you're seeing the inflation. I think the supply chain issues, the V-shaped recovery, so better demand issues, all are contributing to it. But I would say this, that 2 pieces of inflation are more permanent in my mind. And that goes back to the wage number, because I think we hear it all the time from companies, we can't find people. And when we find people, we have a bidding war for these people. And that's not just the low end, it is kind of the middle end too. And so you have wages going a lot higher. And you also have, and not only that, but if you've got a very hot core PCE, and that's what the Fed looks at, right? That's the number that's well above, to your point. We also have higher shelter rents. Rents are up about 5.1% this year. The Atlanta Fed is forecasting 6% for 2023. And usually, and I'm sure you know this, Bob, that rents follow home prices by about 12 months, right? So right now, home prices are up 19% on average. And so you're going to start pricing people out. On the one hand, home prices, if you own a home, you're very happy, right? Because you're up 19, the value of your home is up 19% on average. That's great. But if you don't own a home, many people, it's an affordability issue. Rates are still low relative, but it's the affordability part of it. And it's also the lack of inventory. So then you start to see rents start to increase. And those are the 2 pieces that I think are a little bit stickier in terms of inflation. Are we going to see runaway? No. And the reason is, to your point, commodity prices, they're already rolling over, right? In a pretty big way. And I do think we're going to get a resolution on the supply side, on the supply chain issues. Again, it is not easy. These companies are having a hard time, but I think right now we're at peak supply chain problems.
Yeah, and me too. I was going to say, in terms of inflationary issues from supply chain, I think probably second, third quarter next year, a lot of supply chain issues are going to be worked out. But in the meantime, I was listening to some people talking about supply chain. It's incrementally getting better and better and better and better. At the same time, I think next year demand is going to wane. People are going to start basically spending down their savings and that sort of thing. So I think a combination of demand going down a bit, supply chain going up a little bit, I think we're going to see probably inflation moderate to 2.5–3% next year. I would hope.
I hope you're right. I'm in the camp of it being a little bit higher because, again, I think wages, the labor market is too tight right now, and I don't see that really changing dramatically. It's going to improve for sure, especially as consumers pay down their spend their savings for sure. But the wage numbers are really great, and we are a spending nation. So I continue to believe that the consumer is going to spend. We're not going to grow at 6, 7, 8% next year. But if we grow at 4%, that's still above trend. That's still pretty good. You know, I mean, the normalized rate is 2. So I take 4, right? So I agree with you though, in terms of the supply chain. But I do think these other things are more sticky too.
Right. But I mean, have you seen so far, I'm not so sure I've seen wage increases that have contributed that much to these inflation numbers that we're seeing. They almost seem to be more input issues. Or is that the way you're seeing it or no?
Well, we've seen it. Some of it is input, but also other parts of it are seeing wage increases. You know, we got the productivity.
Well, I see the wage increases. I just haven't seen them like flowing into the inflation numbers.
I think you've definitely seen it in certain reports for sure that wages are up pretty significantly. I mean, let's look and see what the CPI and the PPI numbers, their employment numbers and their wage numbers, but you've definitely seen it, especially on the core side of things. But as I said, unit labor costs are up 9.6%, and that's not all.
No, I guess my point was, I know wages are up, but I haven't seen a lot of reports of companies being able to take the higher wages and basically increase prices to offset them yet at this point.
Yeah, oh, got it. There are, you know what? There are, as you know this, there are haves and have-nots. There are industries that have pricing power, and there are industries that don't have pricing power. And you're going to have, I think next year, that's what makes it kind of difficult. Next year's a harder year than this year, right? And last year was believe it or not, it was an easier year as a PM to find companies, right? Because they just threw everything out, right? And you really got bargains and quality companies and that sort of thing. Next year, it's going to be, A, do you have your supplies? B, do you have the demand? And C, can you deal with these higher input costs and higher wages? And there are industries that do quite well in that environment. I think of industrials, energy, materials, for example. They have pricing power. Discretionary, it's very, very mixed. Consumer staples, it's actually very positive, but you wonder at what point do you create demand destruction? Right. So I don't think you're going to see demand destruction, but you are hearing companies. I did not hear one company other than the financial services sector. I did not hear one company last quarter on any earnings reports that I listened to, the conference calls. Everyone said supply chain and higher wages are a problem. And we're trying to raise price. We can't raise price fast enough, but many companies did. And so perhaps maybe that will help for next year. And then to your point, if in fact supply chain does improve, well, that's going to help margins, right? If you've already raised the price and you got the supplies, and your costs are coming down. But we have a long ways to go before that.
Right, and hopefully probably longer term productivity. I think there's probably a lot of productivity that we're going to see over the next few years that should offset some of the wage gains too. Let me ask you one last question on inflation. A lot of the numbers that we see on inflation are year over year, but last year was pre-vaccine. So you see things like take airfare. Airfare year over year is up, but airfare from October of 2020 is down. You know, so how much of the numbers is a year over year because we're comparing it to a very strange year when demand was down and prices were kind of depressed?
So it's a great question, and I would say I actually look on it on a 2-year basis. In fact, I listen to companies on a 2-year basis, and where are we today versus where we were 2019. And when I listen to someone like, and I'm not recommending this company, but it's public information. The CEO of Expedia was on TV, and he basically said, bookings for 2022, the summer of 2022, are better than 2021 and even better than 2019. And so demand, same with the United Airlines CEO. He said the same thing. They're seeing load factors up 100%, yes, versus last year, but still up versus 2019. And retailers, there's many retailers that you're looking, we always in the retail world, we call it the 2-year stack. That's a funny way of just saying we're looking at it on a 2-year average basis because it can be so volatile, right? And almost every retailer did report better results, better demand results on a 2-year basis. Not to say gross margins were better, because that's the hard part, right? That's where your costs come in and your wages come in. But certain companies, as I mentioned, have been raising prices and raising wages, and I think they're going to be in pretty good shape next year. But again, it's going to be haves and have-nots, and I think that's why you need Bob Westrick to run your portfolios, right? And to have talk to people who run portfolios all the time, because we know the nuances of all these things.
Right. As I'm looking at all the topics I wanted to talk about, I'm about 1/10 of the way through and about 80% of the way through this webinar. So let me go on to to Fed tapering, because this is kind of an interesting one. Now, they started tapering in November. They're tapering about 15 billion a month, so about 12.5% of their buying. So they should be totally tapered come July. What do you think the odds are? A couple things of them speeding up this tapering, number one, and number two, when do you think the first rate increase is going to happen?
Yeah, well, it's interesting because it's the hottest topic out there, right? Everyone's wondering what the Fed is going to do. When I recite some of those stats before about the economy, the unemployment rate, the demand, services, consumer, manufacturing, and then I look at where we are on inflation, again, not runaway, but higher inflation. When I look at all those things together, the Fed does not need to be doing what they're doing right now. And initially they started the taper, to your point, they were going to draw down 15 billion. Now the rumor is over the weekend, they're going to draw down 30 billion. So they're going to go a little bit faster. They can though, Bob. I mean, I'm interested to hear what you think, because I think we are not in an area, we're not in a place like we were. We have recovered. Okay, fine. We do have Delta. We do have a new variant that we have to watch, and others, and we're headed into the winter months, and let's watch the caseload. That's going to be very, very important. But it does look like the Pfizer news today, if you take 3 of their vaccines, maybe that will help this latest variant. And I think that's very, very bullish. But that's your worry point, right? And so I think the Fed is trying to just massage the situation. They see we have better growth. They see we have inflation. That's not, quote unquote, what they used to think was transitory. They're now speeding up. So I think there's a chance that they could end the taper much faster than expected. It could be March, April. And as a result, you could start to think about tightening sometime May, June, summer timeframe, maybe, as opposed to second half of 2022. We're going to have to see the data. We're going to have to see, again, the virus and what happens. But I think they can. And I don't think they're going to all of a sudden end the taper and then jack up rates by 100 basis points in a short period of time. That's just not what Chairman Fed Powell is all about. He's a very measured person.
And I agree with you, Sonny. I think they're going to speed up the taper, and they want to gap some time in between the end of the taper and the first rate increase. And I also think it's data driven. I mean, nobody knows when the supply chain stuff is going to get corrected and that demand is going to wane. I've heard a couple of economists actually think, and this is not the popular view, they say they think there's going to be disinflation come the third quarter because of a combination. Well, I'm telling you, some reputable folks I listen to and I've said it. I'm not sure I agree with that, but I've said it. That said, I think the Fed, they stop tapering, wait for data. I think ideally they would like to not have to raise rates until after the November election, midterms, just to not be accused of being political. I mean, I don't know that they'll get that opportunity, but I think that's what they want to do.
But they have always been data dependent. That's what this Fed is. And so we have to respect the fact that that's what they're going to do. And you know what, look, the facts may change, right? I mean, maybe the supply chains fix themselves in the first quarter, or maybe not until the fourth quarter. I mean, we have no visibility, who knows? But the point of it is these are all the topics that are on our minds, and they're the right questions to ask, and they're the right topics to explore.
Let me ask you real quick, technology. The FANG names pretty much dominated the market and dominated the S&P 500. Yes. Where we've got, Apple, Microsoft, Amazon, Facebook, Alphabet, the usual crew that basically represents more than 20% of the S&P 500. do you think there's other areas of technology we got to start watching, or are these kind of older names still going to be dominant for a while?
I think the answer is both. And to your point on concentration, if you add technology and communication services, right, because they spread out that, they separated out that group, that's 38% of the S&P 500. So to your point, the big guys are dominating. It's crazy that Apple is almost 7% weighting in the S&P 500. I mean, to me, that just blows my mind. But look, you want to own companies. These are really good. The FANG plus Microsoft and some of the others, they're good companies, great free cash flow. Importantly, total addressable markets are enormous, right? I'm not saying that's not priced in, but a lot is not priced in because we still don't even know about AI and augmented reality, virtual reality. We don't even know about the metaverse. That just came out of left field, right? So there are all of these huge total addressable markets that you want to have exposure to. So I would say you want to have exposure to these names because I do think they're going to be, if they're not as dominant, that's okay by me, but they're going to be around. They're going to generate free cash flow. You're going to buy back stock and increase dividends along the way, and importantly, invest in their businesses. That being said, I think you want to have exposure to semiconductor companies because their end markets are also exciting. It's auto, it's Internet of Things, it's 5G, it's data center cloud. So there's plenty of semiconductor companies that are actually trading at half the multiples of some of these other big names that are, by the way, very widely owned, as we very well know. Cybersecurity is not going away anytime soon. But if you ask me, I own one, and it keeps me up at night because it's so expensive because everybody's into these cybersecurity names. Right. But I do think that's a positive trend. And then enterprise IT recovery. As we reopen, you want to be there as well. And that's some of the more value-driven kinds of names within technology. So I think you want to own a barbell within tech.
Okay, let me move on quick to government policy. Monetary, fiscal, still stimulative, probably very stimulative, just maybe every month not quite as stimulative. Yeah. So how much of an effect is that policy going to have going to 2022? And withdrawing liquidity, what do you think that effect will be on the markets?
When you withdraw liquidity, it could have a pretty big impact to the economy. Here's what we don't know. We don't know what the true price of a bond is at this point, right? I mean, they have been buying up a storm, and they've been doing it for years. And now they're going to pull that away, and we're going to have to eventually see where do yields settle out. I don't believe, to your productivity comment, it's very, very important. And that's important in terms of the implications to inflation, and it's important to the overall bond market because we know that they're correlated. So we have to find out what the true level of the bond market is after the Fed pulls away. And do they let rates rise? And what is the velocity of the move? Here's the thing that the market never likes: when we have big moves in a short period of time. Right? I mean, the day after Thanksgiving, for example, I mean, it was just pile on. Everyone was concerned about the new COVID case, the variant, and it was the unknowns, right? And then slowly but surely we started reading, maybe it's not as big of a threat. And so the markets kind of recovered. It's the same thing with interest rates. If the velocity of the move is a spike, the markets will not like that. If the Fed can keep it under control and we see gradually higher rates, because the economy is actually stronger than average, that's not a bad thing. And I think the market would be able to handle that. Now, within that, if you see rates go a lot higher, you might see a rotation out of long duration assets like the technology names we were just talking about. You might have more into value, into small cap, and into more cyclical companies and reopen companies. That's the way I'm positioned for 2022 for now. But let's see how the Fed pulls this policy away and at the speed at which it does.
Gotcha. You know, where we are right now, by the way, it's unfortunate this webinar isn't like 3 hours. We have so many other things I would love to talk to you about. At this point, though, I think I'm going to go back to Nicole and see what kind of questions we might have from some of our viewers. Nicole?
Yeah, thank you, Bob. For our viewers, I just want to remind you all that we are taking live questions, and how you're able to ask those live questions is if you are on your Zoom screen, go ahead and take your mouse down to the bottom and kind of wiggle it around, and you'll see an option there to raise your hand. So if you have a question, go ahead and raise your hand and I'll call on you and unmute you, and you can ask your questions directly to Bob and Stephanie. But while we wait for any of those brave souls to step forward, I do have some questions that were emailed to me. So let's start with those. So the first question is about fixed income. And the question is, what are trends in fixed income? Can people still make money in traditional fixed income assets?
I think it's really hard. It's a great question. I get this question all the time. Bob, you probably do too. Is 60-40 dead, right? That asset allocation, 60 equities, 40 bonds. I get it all the time. And I say, I think it's very hard to make money in fixed income, but I honestly have been wrong. I thought that for sure it would be a much different outcome, just given that we have seen the recovery and the growth in the economy and the higher inflation. But I do think, I strongly believe that we do not know the true levels of the bond market at this point without seeing if the Fed pulls from QE, what that means, what that does. But the net of it is right now, it's hard to put fresh money to work in fixed income, and I certainly wouldn't want to go up the risk scale to high yield, that kind of thing. But for now, people continue to want some munis, some corporates, and then maybe diversify into REITs, utilities, that kind of alternative where you get the yield. The yield is safe and well covered as a diversification measure.
And so, to your point, as interest rates have remained just like generationally low at Private Vista, right now our allocation team has approximately 50% of client fixed income in alternative, not traditional fixed income. Because when rates are this low and interest rates are probably going up, there's probably not a lot of money to be made in like treasury bonds or even AAA corporates or
no, you can't. And it's funny, when I first arrived here at Hightower, and I was meeting all the advisor teams, the number one question, what do you think of alternatives? Is that a good alternative? So you're ahead of the game. You're ahead of the game, for sure.
Yeah, you have to be. All right, Nicole, got any other ones?
Yeah, actually, we have Bruce here who's going to ask a question live. So Bruce, I just gave you the permission to unmute your mic if you are able to unmute and ask Bob and Stephanie your question.
What about crypto?
Oh, I knew there was going to be a question
Somebody
on
had
crypto.
to ask crypto, yeah.
Somebody has to ask a question on crypto. Here's my take on crypto. It's volatile. It's I understand the storage argument or investment. I understand the inflation hedge investment as well, and thought process there. I think it's a very volatile asset class right now that if you are going to invest in it, it would be a very small percent of my overall portfolio, like 1%, so that you don't have to worry. Because here's the problem: you wake up one day, it's at 30,000. You wake up the next day, it's at 80,000, or whatever it is. That volatility, it's not trading on fundamentals because it's still such a new asset class. Now, that being said, I think you can own the exchanges in terms of where you would get exposure from the volatility, number one, the fees that they generate, number two, but you want to play with the big players that have the diversification so that, again, you're not just Bitcoin or Ethereum, and they all do they kind of trade together similarly, and they also trade when it's kind of quote unquote risk on as well. So I understand why people have an interest in it. I get questions all the time about it. The total addressable market is enormous. It is 1.6 billion today. It's going to 2.2 billion by 2024. So you may want to have that kind of exposure, but I would be more focused on the exchange side of things versus the actual Bitcoin itself.
And at Private Vista, our teams have been watching crypto for a long time. And the way we look at it, I mean, it's more of you can take a bet on crypto right now. That's what we view it. It's developing, it's growing day by day by day by day in terms of how many people are buying it and that sort of thing. But we don't feel at this point yet it fits in a client portfolio. And kind of to Stephanie's point, you can only take so much volatility in a portfolio. The question is, where do you want to put your volatility?
Yeah.
And something like crypto too, you don't know correlations with other assets yet, because once again, to Stephanie's point, it's too early. And we like to know assets and asset classes. We like to know their correlations to other assets and other asset classes, so they fit in and make a portfolio. So my final answer would be, yeah, it's common. But then all of a sudden it might be like booming, and then the government comes in and like, now we're going to regulate it, and all of a sudden it goes the other way. This is the beginning of a long story. Buy 1% of it, 2% of it in your portfolio, sure, it might be great, but you know, more than that right now, it's more than an investment. It might be more of a bet.
Thank you.
Sure, thanks, Bruce.
Okay, yeah, thank you for that question, Bruce. Let's move back on over to another question that was sent in via, let's move to another question that was sent in via email. And that question is going to be around growth stocks. So the question I have for you two is, growth stocks have been dominating the market for many years now, it seems. Do you see value stocks taking the lead anytime soon?
Bruce, Bob, would you like to start?
I'll jump in and I'll say, yes, I do. Yes, I do. And I'm not saying, you know, once again, all we do is kind of tilt portfolios one way or another. Growth, the question, the way it was posed is exactly right. Growth has been crushing value. Value all of a sudden last year in the fourth quarter, all of a sudden came roaring back. You know, and even in the first quarter, value was doing well, till all of a sudden, you know, Delta reared its ugly head again. And then, you know, what do people want to go into? They want to go into tech. That's kind of like the safe haven of COVID. And what's tech is growth, right? But over the years and years and years and years, when you go back and look at decades, growth and value are really pretty darn close into total returns, you know? And once one has led for a while, typically the other one takes the lead. So I think value will be taking the lead. You know, we saw it after the dot-com bubble burst. You know, growth had been crushing it in the 90s. All of a sudden, dot-com bubble burst, and it was value for the next, 4 or 5 years. So don't count value out. They're still in this race.
And I totally agree. I would say if you think big picture and you believe my theory, and that is that I think growth is going to stay above trend. Not at the levels we've seen this year, but it's going to stay above trend, and you have a little bit more inflation. Value tends to outperform growth. When you don't have good growth in the economy, that's when growth really outperforms value. And that's because growth stocks can actually grow no matter what the macro environment is doing. And that speaks to the total addressable market story that I was talking about. And that speaks to the massive free cash flow, balance sheets, et cetera. And the companies keep plowing money into their companies and finding new technologies. As I mentioned, I didn't know the metaverse 6 months ago. And then all of a sudden you start reading all about it. Well, guess what? Now all of a sudden Facebook changes its name to Meta. I mean, the whole thing is just so quick. And so I think you definitely want to have exposure to kind of secular growth technology companies, secular healthcare companies. I think that's a very powerful area. But I think you want to have a barbell and have also some value, some economically sensitive companies in your portfolio, as well as maybe some small or mid-cap kind of companies, and reopen names as well. You don't want to have all one or the other,
Especially when you look at growth valuations these days. Yeah. And if there's going to be PE compression at all, it's going to happen more in the growth realm than it's going to happen in the value realm.
And and as we talked about, it's so over-owned. The big names, as to your point, Bob. The big, let's just call them the big 7 or 8, right? I mean, they're so over-owned in every single portfolio. So it doesn't take much.
People have more growth in tech than they probably think they do in the portfolios. Yeah.
Agreed. Yeah. That's a good point.
Nicole?
I have, I think, time for just one more question, and then we'll wrap up after this. But I think this final question, having to do with market trends, would be a good way to send us off. So the question is, what market trends that we've seen during the pandemic do you think will continue, and which ones do you think might end?
Well, I would say obviously the big one is stay at home versus return to work. I think that the stay at home companies really had a powerful combination of good technologies, things that people needed, and what companies were spending on, meaning cloud infrastructure and that sort of thing, and software. So I think cloud is not going away. Infrastructure is not going away, and working from home is not going away 100%. I really still believe, I very much believe that you're going to see a hybrid kind of thing, so that you are going to continue to see some of the stay-at-home companies still do very well. And oh, by the way, they're the ones in the last month that have really gotten hit hard as people are focused more on that travel leisure segment that I was talking about. I think there are some opportunities in this pullback on companies that have a uniqueness, right? They're number one in their industry. They have great free cash flow generation, and they are investing in their businesses. But you have to be careful because they've had a nice run. They're not trading on earnings because most of them don't have earnings, and so so therefore the multiples are very expensive. And the flip side, I think you want to also own these reopen names. I wouldn't own necessarily like airlines per se, but I don't know why, a hotel or a restaurant, some of the retailers as stores reopen and that kind of thing. So that's the way, at least I'm positioned for next year. How about you, Bob?
I agree with everything that you just said. In terms of COVID, I think a lot of folks realize, when I say folks, a lot of businesses realize, people really can work from home. I used to either work from home with one of these things. Oh, you're working from home. I said that once to my sister worked from home, and she almost like bit my head off. She's like, I got off my computer at 9 o'clock last night, Bob. I am working from home. And I, all right. So I had never really worked from home, and did during COVID for 18 months. And I'm really, really productive from home. I mean, there's no top-ins, but the flip side of that is there's a lot to be said for company culture and people coming together and just being able to have just drop-ins and talk and communicate and greet and that sort of thing. So we're gonna be hybrid for sure. We're going to be hybrid, and many companies that I read about are going to be hybrid. And because of that, a lot of the companies that did well, that probably will continue to do well, are a lot of these technology companies that enable us to do what we're doing, like Zoom, right? Yeah. Anything else, Nicole?
As it is 4:50, I think we're actually going to wrap up here if you guys don't mind.
Very good. Well, let me say then, first of all, Nicole, thank you for organizing this. I appreciate that. Stephanie, it's really been an honor and a pleasure hearing your insights and everything that about your industry and these markets and that sort of thing. And we'd love to have you back again, because like I said, I got to about 1/3 of the topics I wanted to talk about. These things are so fun to talk about. We can talk about them all day. So thank you so much. And I would like to say thank you to everybody who joined us, letting us come into your homes, your offices, wherever we are today. We appreciate your interest. We appreciate your time. All our clients, we appreciate you as clients, and we thank you for trusting us with your planning and your portfolios. If you have any questions, please never hesitate to contact any one of us here at Private Vista. With that, I'll say thank you and good evening.
Thank you.